Welcome to the PAI Morning Briefing. I'm your host from Pantheon AI, and today is March 18th, 2025. Good morning, everyone. I hope you're sipping your coffee, getting ready to dive into some early market insights and thoughtful commentary because we have a lot to cover today. Let's jump right into our discussion.
Let's start with a quick market overview. The major U.S. equity indexes are taking a hit early today with some downward pressure. The S&P 500 is currently trading at approximately 5,620.3 and showing a decline of roughly minus 0.6%. Not too steep, but it's a sign that caution is in the air. Meanwhile, the Dow Jones Industrial Average is holding around 41,675.67 with a modest decline of about minus 0.23%. On the technology-heavy Nasdaq, which tends to react quicker to market sentiment, it's sitting at about 17,510.67 and is down about minus 0.86%. And for those monitoring the smaller cap stocks, the Russell 2000 is trading near 2,051.32, down close to minus 0.5%.
Let's not forget the cryptocurrency space, which has been in its own turbulence lately. Bitcoin is priced around $81,418.9, down by approximately minus 3.1%, while Ethereum is trading at roughly $1,887.5, sliding by around minus 2.03%. Clearly, there's a general mood of caution and some profit-taking that seems to be resonating across different asset classes.
Now, while these numbers might look concerning to some, I'd encourage you to think about what's driving these moves. It's easy to get caught up in the minute-to-minute fluctuations, but let's put these moves into the context of the bigger picture. We're living in an era marked by significant geopolitical shifts, evolving monetary policies, and yes, a constant stream of corporate news that keeps driving market reactions. Sometimes I wonder if even the markets have their own personalities. They have good days, bad days, and days that remind us to maybe take a breather and enjoy some extra coffee.
Let's now deep dive into the major market trends recently observed. A dominant theme that has been emerging is the flight from U.S. equities by institutional investors, a trend that many experts say is the fastest we have ever seen on record. According to a series of Wall Street surveys from Bank of America strategists, institutional investors are pulling money out of U.S. stocks at an unprecedented pace. The headlines have been screaming this news repeatedly, and rightfully so, because it is surely a signal for investors to reassess risk and consider diversifying their portfolios.
What does this mean in plain language? Essentially, these large money managers are losing confidence in the current valuation of U.S. stocks, at least for the moment. When institutions, which tend to have far more resources and data at their disposal, start pulling out funds, it often makes the rest of us take notice. Of course, this trend might be deemed as overreaction by some commentators. After all, every now and then a market correction is healthy, and we have seen similar patterns in previous economic cycles. Yet the pace at which funds are exiting is historically significant.
Could it be that these investors foresee a more prolonged correction ahead, or perhaps they're repositioning themselves in anticipation of a new buying opportunity? My own take is that while the sentiment might seem pessimistic in the short term, it creates pockets of opportunity for those who are patient and willing to ride the waves. It's the classic case of contrarian investing, buying when others are selling, and vice versa, a strategy that has served legendary investors well over time.
Speaking of big moves, another headline that has captured significant attention is Google's plan to acquire the cybersecurity company Wiz for a whopping $32 billion. Now, this is a deal that frankly makes for some very interesting dinner table conversations. Wiz, founded only 5 years ago, has rapidly ascended the ladder in the cybersecurity world. In today's environment, where cyber threats are escalating both in complexity and scale, acquiring a company with a robust cloud security service seems like a masterstroke on the part of Google. It's not every day you see a tech giant making an acquisition of this magnitude, and it certainly raises the stakes for competitors in the same space.
For those new to the story, let me summarize. Wiz has become a beacon in the world of cybersecurities by assembling an impressive executive team and offering unique solutions to counter cyber risks. Google's move isn't just about expanding its portfolio, it signals a broader strategic focus on security as an indispensable aspect of cloud computing. One could argue that this acquisition might also have ripple effects throughout the technology sector, potentially pushing other firms to either enhance their cybersecurity capabilities or consider similar aggressive expansions.
Moving on, another important topic circulating the news cycle is the decline in the S&P and Nasdaq indices today, a development that seems to be part of a broader technical shift in the market. We have seen days where the S&P has bounced above its 50-hour moving average, giving buyers a sense of optimism, only to see the market gap lower later on and push hardware suggestions that imply more work to be done to restore bullish momentum. It's a reminder that while technical indicators can provide useful signals, the market always retains an air of unpredictability. Even the most reliable technical models can get caught off guard by unplanned economic data releases, corporate news, or geopolitical events.
And speaking of corporate news, our next set of stories centers around what Jim Cramer has identified as the top 10 things to watch in the stock market on Tuesday. Jim Cramer's list, which highlights key financial moves such as Google's largest acquisition to date, as well as major keynote announcements from influential figures like NVIDIA's CEO Jensen Huang, helps provide a snapshot of the sectors most likely to drive market movement over the coming sessions. While I always take these lists with a healthy dose of skepticism and a dash of humor, because if there's one thing I've learned in this business, it's not to take any prediction too seriously, they nonetheless serve as a useful barometer for where energy and investor attention might be focused.
Now, given that we essentially have repeated headlines and multiple mentions of these stories in today's news cycle, it's worth asking, how often do we see the same news items surfacing from multiple sources? Some might say it's redundant, but there's a logic to it. When a story is repeated across various outlets, it underscores its importance in the current market environment. Whether it's the extraordinary pace at which capital is leaving U.S. stocks or the dramatic nature of a major tech acquisition by Google, these stories dominate headlines because they carry significant implications for market sentiment.
Let's delve deeper into each of these significant narratives, starting with the capital outflows from U.S. equities. It's not merely a headline to capture attention, it speaks volumes about investor psychology and the broader macroeconomic conditions. Institutional investors are typically guided by a combination of quantitative models and qualitative assessments. When their models start signaling increased risk exposure or potential market corrections, the instinct is to reduce exposure. This movement has been noted as happening at the fastest pace on record, suggesting that fear might be trumping greed more so than usual. But, as with any market behavior, there are two sides to the coin. Those extremely short on the sentiment spectrum could very well be setting up fertile ground for a bounce, should assurances or better-than-expected economic data emerge.
Turning our attention back to the tech sector, the acquisition deal between Google and Wiz is worth a closer look. Cybersecurity has become an increasingly crucial element in every aspect of modern business and personal computing. With rising incidents of data breaches, ransomware attacks, and other cyber threats, companies that can provide robust security solutions are in higher demand than ever. Wiz, though young, has carved out a niche that makes it extremely attractive to established players like Google. It'll be interesting to see how this move influences not only Google's own strategies, but also the broader market dynamics within the cybersecurity space. Will competitors be pushed to increase their own R&D investments? Could we see a domino effect leading to an accelerated consolidation in the cybersecurity industry? These are the types of questions investors should ask as they consider the longer-term implications of such acquisitions.
Another dimension worth discussing is the nature of market fluctuations today, particularly with the technical correction seen in the S&P and Nasdaq indices. While these markets experienced some minor gains yesterday, the gap lower today is a stark reminder that markets can be fickle. We have seen multiple examples where short-term bullish indicators, such as moving averages or momentum indicators, are quickly offset by broader underlying concerns. In today's case, alarm bells are ringing not just from the technical side, but from macroeconomic factors, trade concerns, and global uncertainties as well. It's a situation where every piece of data must be analyzed with a critical eye, and where context is just as important as the raw numbers. I like to think of it as trying to guess the punchline to a really intricate joke. The setup is there, but the payoff isn't immediately obvious.
Now let's talk a bit more about Jim Cramer's top 10 list for the day. While there are a handful of key items on the list, a couple stand out distinctly. Not only is Google making its largest acquisition to date, but we're also hearing high-profile keynote addresses from influential tech leaders such as NVIDIA's Jensen Huang. These developments have the potential to redefine market sentiment and catalyze further movements in technology and innovation sectors. It is fascinating to observe how major corporate maneuvers and public endorsements can tilt investor confidence. After all, in a world where market dynamics often seem to mimic weather patterns, sudden showers, unpredictable thunderstorms, and the occasional gust of sunshine, every new nugget of information adds weight to the overall narrative.
Let's now transition into a detailed sector analysis, starting with technology. The tech sector has been on a thrilling roller coaster ride recently. On one hand, we have major tech giants like Google not only venturing further into acquisitions, but positioning themselves to control broader ecosystems ranging from cloud computing to cybersecurity. On the other hand, the very players who drove the tech rally in previous years are now grappling with supply chain issues, regulatory scrutiny, and a push from investors to justify their lofty valuations. Google's venture into cybersecurity with the Wiz acquisition, for instance, is a strategic move to diversify its revenue layering while staying ahead in the race against cyber threats. But it isn't just about buying companies. It's also about setting a direction that other firms will likely follow.
The question for many in the tech space is, how far are we willing to stretch our technological ambitions before the inherent risks start to outweigh the potential rewards?
Moving on to the energy sector, even though we haven't had as much direct news about energy in today's briefing, we cannot ignore it given the intertwined nature of global markets. Energy prices continue to be influenced by geopolitical developments and supply chain considerations. With the shifting dynamics in international relations and the overview of global policies aimed at sustainability and greener energy solutions, energy investors must remain vigilant. The juxtaposition of high-tech advancements and energy market fluctuations is interesting because energy forms the backbone of the industrial and technological transformations taking place. When tech companies, for example, talk about large-scale adoption of artificial intelligence and massive data centers, they ultimately depend on reliable energy supplies. So even if the news today didn't exclusively spotlight energy, it interjects itself into the canvas as a silent yet pivotal player.
The financial sector is currently seeing its own challenges as well. With capital outflows from U.S. equities, there's pressure on banks and financial institutions to reassess their positions. Many large institutions have been acting on predictive models that suggest an upcoming period of heightened volatility. These financial entities are known to adjust very quickly, and while some might argue that such fluctuations are cyclical, the speed and volume of these changes are catching even seasoned analysts off guard. It raises an interesting point. Are we in for a prolonged phase of recalibration for the financial sector? And if so, what does this mean for retail investors and the everyday person watching their retirement portfolios? The interplay of macroeconomic policy decisions and individual investor sentiment makes the financial sector one of the most dynamic and at times unpredictable segments of the market.
There are also notable global market implications that can't be ignored. While the U.S. markets are often the epicenter of global financial news, investors around the world are keenly watching these developments. The pattern of institutional outflows, technological acquisitions, and technical corrections in U.S. markets can signal a broader shift in investor sentiment worldwide. European, Asian, and emerging markets might well feel the spillover effects of these trends. For example, if major U.S. institutions are realigning their portfolios, international funds might similarly adjust their positions. Moreover, as tech giants set the pace with massive acquisitions, global technology players may be prompted to re-strategize, leading to a ripple effect in innovation and investment patterns internationally.
Looking ahead with expert insights and predictions, I'm personally curious whether these trends are harbingers of a more significant recalibration in investor confidence or merely a temporary reaction to industry-specific news. It wouldn't be surprising to see market analysts debating for the next several days whether we are witnessing the early signs of a downturn or whether these are isolated incidents isolated to a period of high volatility. One thing I can say with confidence is that events like Google's acquisition and the massive institutional fund outflows serve as both wake-up calls and opportunities. They force us to re-examine our assumptions about market stability and growth. For the astute trader or investor, this is a time to consider diversifying portfolios, honing risk management strategies, and maybe, just maybe laughing at the often absurd interplay of market sentiments.
I mean, if the stock market were a sitcom, you'd know the laugh track was running a bit too loudly these days, wouldn't you?
In addition to our primary markets and sectors, let's spend a few moments discussing some thought-provoking questions for you, our valued audience. What does it tell you when even the largest institutional investors are showing unease about the U.S. stock market? Could this be the moment you have been waiting for to reassess your own strategy, or perhaps a cautionary tale to remain nimble? And when a tech giant like Google steps into the cybersecurity arena with such a bold move, are we looking at a sign of sweeping technological consolidation in the near future? These are not just rhetorical questions, but invitations for you to dig deeper into your research and, if needed, have a dialogue with our AI co-pilot. After all, sometimes the best insights emerge from the questions we ask rather than the answers we expect to find.
As we wrap up today's briefing, let's summarize the key takeaways. First, the U.S. equity indexes are under pressure early on, with modest declines across the board, from the S&P 500 to the Nasdaq and Russell 2000, while Bitcoin and Ethereum in the cryptocurrency space are experiencing sharper pulls downward. Secondly, institutional investors are rapidly reducing their exposure in U.S. stocks at a record pace, a phenomenon that demands a closer look into investor sentiment and risk management strategies. Third, headlines are abuzz with Google's audacious move to acquire Wiz for $32 billion, a strategy that is poised to deepen its foothold in the burgeoning cybersecurity sector, a sector that is becoming increasingly critical in today's digital age.
Additionally, the technical corrections in the market, as evidenced by the recent performance of the S&P and Nasdaq indices, remind us that even in periods of short-term gains, there is a latent caution underscored by economic and geopolitical uncertainties. Jim Cramer's top 10 list, replete with mentions of major corporate moves and important keynote speeches from industry leaders like Jensen Huang, provides another layer of context, emphasizing that investor attention is sharply focused on both short-term catalysts and long-term strategic shifts.
From a sector standpoint, technology continues to lead the conversation amid bold acquisitions and aggressive innovation strategies. The energy sector, while less in the limelight today, remains a critical underpinning for both technological progress and industrial growth. And the financial sector, facing its own set of challenges and volatility, underscores the need for robust risk management as investors brace for potential corrections.
When we widen our lens to view global market implications, it becomes clear that these trends are not isolated to the United States. The interconnectedness of today's financial world means that shifts in U.S. market sentiment can have far-reaching impacts on international markets, and even on the strategies of companies outside the traditional tech and finance sectors.
Before I sign off, I'd like to inject a little bit of humor into our discussion. They say that investing is a lot like dating. One minute you're head over heels with that hot new tech stock, and the next you're ghosted by market volatility. If only our relationships had as clear a set of technical indicators as the stock market. It's these little jokes that remind us, even in times of uncertainty, a good laugh can serve as a sanity check.
And now, as we close out today's discussion, I encourage all of you to reflect on the themes we've discussed. Are you ready to rethink your strategy in the wake of these record-breaking fund outflows? How might the Google acquisition affect your outlook on cybersecurity stocks and technology investment as a whole? And what does the oscillation between technical gains and sudden market dips say about where we might be headed next? I invite you to share your thoughts and questions with us, because dialogue and curiosity are what propel us all forward in this complex financial landscape.
Thank you for joining me on this in-depth exploration of today's financial landscape. I want to give a big shout out to Pantheon AI for being your information co-pilot, guiding you through these turbulent yet fascinating times. Join me again in the next episode tomorrow, where we'll continue to break down the developments shaping the market and explore new insights for your investment strategies. And remember, if you ever find yourself puzzled by the market's twists and turns, you can always ask questions to our AI co-pilot.
Until next time, keep your investing strategy sharp, your minds curious, and as always, remember that learning should feel like a full-time job. Have a great day, everyone.